Folks, welcome to the week ahead commentary. This is where we review the closing price action of the equity and bond markets last week. We talk a little bit about strategy as well as you proceed into the new trading week in the back half of the year. And as you proceed into the new year, we're changing things up at the Contrarian Trader. And in 2023, there's going to be renewed focus on growth, whereas in 2022, it was more a matter of maintaining a liquidity position that allowed us to engage our membership with new products such as options, to be specific, options writing and not necessarily buying and generating cash flow. We began that in April of 2021. We continued it through 2022 successfully. Did we have our pain points at times? Yes, we did, but those only came on earnings trades, which we've kind of backed away from during this market backdrop of one that is punishing companies dramatically when they disappoint on earnings. There's just not enough reward for the risk that we take on with those trades. But by and large, we've had a very good 2022. But in 2023, we want to refocus on growth, meaning I just had surgery in October the 7th to be specific. I've been out of the gym. I've gone back a couple of times, but nothing really aggressive. But now that I'm in the 7th week of healing, I'm going back into the gym, and 2023 is going to be a focus on health, not just physically, but mentally as well. And also, we're going to be looking in terms of expansion of the business. How will we do that? Well, we'll be engaging newer viewers with commentary like this, which has traditionally been for members. That being said, there will be more exclusive content for members. In this case here, we'll be cutting off this commentary once we get to our positions and we discuss what we're going to be doing with those positions moving forward. And if you're currently a member, the full-length version is in the members area or has been emailed to you. And we're going to do a little bit of trial and error here, see what works, see what doesn't work. But in the end, what we want is engagement. So if you're not currently a member, please like, subscribe, leave a comment. What could we do better here as you move into 2023? Whether it be video commentary or in the live streams, it doesn't matter. And I'll definitely get back to you with a thank you or reply to a question. So let's get to it. As we always do, we always begin with the bond market. The bond market is the tail that wags the stock market dog. And to understand where the markets are going to be going moving forward, you must appreciate the value of understanding the influence that the 10-year yield has on the stock market, and in particular with different sectors. Now, the 10-year yield, this is a daily view, you could see is putting in a potential head and shoulders setup after putting in a double top, breaking down to new lower lows. This is a short-term bearish trend, and it continued on Friday. But as we take a look at the macro view, the weekly view, you could see that we are still in a threatening bull flag setup. And we could stay within this trading range, the lower band in blue, upper band in blue, for a couple of weeks to a couple of months without breaking trend. So after putting in a reversal week, the week prior to last, to close up on the week, yields closed down, which was bullish for equities. We're not going to talk too much about Friday's price action. It was an abbreviated, very, very light volume session. Now, will the pullback on bond yields continue? Probably. We have a lot of problems. Economic data is not good. We are in recession, despite the fact that they redefined in Wikipedia what a recession is. We don't drink that Kool-Aid. We have two back-to-back quarters of negative GDP. End of statement. We are in recession. Yes, we have had one positive quarter of GDP since putting in the second quarter of negative GDP, and perhaps we'll see a economy that emerges out of a recession in early 2023. But when you take a look at the yields and you have the Federal Reserve raising rates at the most aggressive rate in history, you have to wonder, why is the 10-year yield dropping? Why is it not rallying as it had been? Could it be that it was overbought and it's consolidating? Sure. or there's something very, very wrong with this economy. You have mass layoffs that are coming. You have an inverted yield curve, which is the lowest pretty much in history. Now, we'll be talking about the yield curve tomorrow night. Don't forget, join up by simply clicking the notification bell or enter your email address below and get notified when we go live about a half hour to 45 minutes prior to us going live. If you're already on our opt-in email list, please don't re-enter it. We don't want to spam you. So the 10-year yield last week is a glimpse. It's a glimpse into the health of the overall economy, and it's not looking good. Now, as for the tip market, Treasury inflation-protected securities, they had a very strong week last week, and while I've been very skeptical of this rally, and I still remain skeptical of this rally, because this, to me, appears to be a bear flag setup, much as what you had back here, and much as what we did last week. We broke out, and then ultimately we rolled over. That could be happening yet again. I do not believe in V-shaped recoveries. Can they happen? Sure. But usually you get a W formation, basically a double bottom setup. And that sets a stage. It creates a base for stocks, bonds, whatever you're trading cupcakes. It doesn't matter. You want to see them break out of a very sound base. Now, taking a look at a daily view of the tip market, you can see that while down on Friday, again, abbreviated day, we're not going to put much stock in that. It might as well not have been open. We did close off the lows of the session. It appears as though there's more room to run here. The 20-period moving average in green crossing above the 50-period moving average in blue. So those are observations that are very bullish for the tip market. The dollar. The dollar last week flashed a bearish key reversal bar. This allowed our gold, silver, and mining stock positions to just rip up higher. Now, we do have support immediately below. The stochastic indicators are very, very weak. RSI, very, very weak. Volume was weak last week as well. So it appears as though we'll at least retest support. Let's see whether or not we base there. Daily view. Daily view. An inside bar on Friday. No new high, no new low. Stokes rolling over. I suspect that we're going to get lower lows here. And folks, we'll talk about gold in a moment, even though it's one of our positions, as is silver. But you really need to focus on in 2023 on owning tangible products, physical products, in particular gold and silver. And the why behind that is that you have a digital currency that is going to be road tested, and it could very well be rolled out next year, the year thereafter. And the fact that it's programmable doesn't give me a lot of confidence that I want to own US dollars. And I think that in advance of the rollout of the digital dollar, you're going to see a sell-off in dollars. You're going to see money leave the US dollar in droves. And you don't want it to be in an account where it could be seized. Basically, if you bought the GLD, they could seize that in a heartbeat. It's going to be very difficult for them to seize your gold 1-ounce bars or 10-ounce bars, whatever you're holding. So please purchase the physical. We do have some electronic silver, but we keep that there for liquidity. Now, will the dollar continue to drop off next week? Well, taking a look at a weekly chart of the euro, it appears as though we are going to move up higher. There will be resistance at 97, though. Strong weekly chart. The yen, for its part, it broke out last week. It had broken out 3 weeks ago, failed the week thereafter, recaptured last week. That's very strong price action. So the dollar has trouble. As for the VIX, I had a little bit of conversation about the VIX with members last week, and the VIX is oversold. I mean, it's due for a bounce. Before we go to the daily chart, the counted sequential days of a drop in the VIX, take note of where we're at. We're at support, and I do believe we can shoot down lower because we are in a seasonally favorable period of time for stocks. So we could see a 19 handle on the VIX daily view. Now you can see that the VIX had 6 sequential days of downside move. Friday ended that. And from its prior high, the VIX is now down around 42%. So when we take a look at what's out there, whether it be the Ukraine, whether it be the South China Sea, whether it be political ineptitude in Washington, D.C., there are a lot of threats out there in the market as we go into 2023. So I suspect that volatility is going to remain elevated, and we're not going to see the doldrums that we saw back in the 2000s when we hovered, I should say early 2000s, down at around a 10 handle for the longest period of time, rallied during the financial crisis and then dropped back down to, let's say, on average, a 12 handle. I don't think that we're going there, which is why we favor option premium selling right now. It gets us far away from the current share price, and it keeps us hedged and we're generating cash flow. And it keeps us several deviations away from a potential black swan event, the Dow transports. Now, here's where things get a little bit more bullish from my perspective. The week is obviously now over. And what do we see here? First off, let's talk about the Dow transports and what it means to us here. What it means to us here is that the Dow transports is what I like to call our canary in the coal mine for the equity market. Usually it leads the way, either to the upside or to the downside. Now, when you take a look at this chart here, we broke out the week of November the 7th, pulled back, we tested a couple of support levels the week of the 14th last week. Bullish key reversal bar. This is sound price action. This would imply to me that we're going higher on the Dow transports. Obviously, volume to the upside was very light last week. Let's check out a daily view. Daily view, I'm a bit suspect given the light volume action of last week. You know, I'll take the crayon out here and I'll show you why, what I'm looking at. And it may be nothing, but I like to memorialize these observations because usually I'm right. Sometimes I get it wrong. And this to me is my classic bear flag setup. So if we break out higher, okay, then it's game on to the long side for the Dow transports and in all probability the Dow Jones Industrial Average and probably the S&P 500 as well. But if we fail and we break this lower band of support and we move lower, well, then all bets are off. The Dow Jones Industrial Average weekly chart, very similar to the Dow transports, but in fact more bullish because unlike the Dow transports, which managed to hold and recapture support, as noted here, you take a look at the Dow Jones Industrial Average, it had a continuation breakout last week. But what we do need to do here, though, is keep things in perspective and say what was our volume last week. And it was obviously very, very light. So really pretty chart, no doubt about it. But to keep things in context, volume was very, very light. So this is a full trading week coming up. Do we consolidate? Do we see a continuation breakout? We don't know. We're not that smart. The market's going to tell us. And we'll trade in the direction of the market. Right now, we're positioned, by and large, net long of the market. And for a couple of reasons. One, technically, the charts are fairly strong. Two, seasonality. Seasonality favors longs this time of year. The caveat being, you're going to have non-farm payrolls coming up, as well as the last Fed meeting of the year in the first 2 weeks of December. And historically, and I'll go over this tomorrow night on Sunday Night Futures Live, using the chart off of TrendSpider, historically, those 2 weeks are choppy in terms of volatility. But the final 2 weeks are usually smooth sailing into the back half of the year. So the Dow Jones looking good. S&P 500 weekly view. Not all that much unlike the Dow Jones Industrial Average. We're going to probably rally up to, I would say, 4,100 on the S&P 500. Then we're going to have to take a step back and reevaluate because where we'll be leaning into is the upper band of this downtrend channel. So the question is, do we break out or do we break down? The safe play throughout 2022 has been that you will break down. The Trip Qs, weekly view. They as well broke out. The why behind that breakout, look no further than the pullback on the 10-year yield. We spoke about that earlier. And looking at this chart, and we do have a number of QQQ names in our portfolio, it looks as though we are probably going to move up higher after breaking out 3 weeks ago. And this is a very similar chart as to what we saw in the Dow Transports. Unlike the Dow Jones Industrial Average and the S&P 500, we didn't see a continuation breakout last week. This is more akin to the Dow Jones Transports, but bullish nonetheless. The banks weekly chart, a very strong chart. We've been saying that we're bullish on the banks. We have a big W formation, and we have now broken out above the pivot point at 35.78. I think the banks, in all probability, are going to finish off the year strong and could quite very well, absent a black swan event, given this FTX debacle, they could quite very well proceed up higher into the new trading year. The only question that's out there is who has counterparty risk and who's at risk for taking a nosedive and possibly going bankrupt due to their business dealings with FTX. So there's going to be more to come out on that in the coming months. It's not over yet. So that's really the only warning flag I have here. Daily chart, we're nearing resistance, but resistance levels are made to be broken through. Obviously, volume is very light last week. That's why I haven't spent a lot of time on the daily charts, this commentary. Technology, weekly chart. It broke out last week, consistent with the Trip Qs, fairly similar chart. They're highly correlated. Volume was obviously very light. So these charts so far, I mean, semis, same deal here. They broke out. They held the breakout point. They appear as though they want to move up higher. So we're going into the new trading week, not as bullish as what we were because we called a rally about 3 weeks ago and we got the rally. Now we have a breakout. The question is, can we capitalize on it and move up higher, or do we roll over? Personally, we're still biased long. Consumer staples, ripping, a very powerful chart here. This is a chart that is saying the bear market in consumer staples, and for those not familiar, consumer staples, those are your gotta-haves. Those are your Krogers of the world. That's where you buy your food, etc. They are doing very, very well because money is moving into staples because people don't have money to buy discretionary goods. They are broke. Who benefits? Staples. So the bear market, for all intents and purposes, is over in the staples. The question is this going to be a one-trick pony, or will you have other sectors join in? I think that there are going to be other sectors that join in. I think that 2023 is going to be a stock picker's market. We're going to continue with our strategy of selling premium. I'll never give that up. Our option selling premium business is just, I love it. It's just an outstanding business model. But we are going to return to a more swing trading mentality. Now, when I say swing trading, I'm not talking about day trading. I'm talking about multi-day to multi-week trades that we're going to put on the table. And in fact, one of the videos that I put out usually each week for a long, long time, many years, I had stopped doing consistently, and that was the best stock charts for the new trading week because we backed away from aggressive swing trading. But given the improvement in the markets, we will return to that strategy. XLY, weekly view. All right, so while the staples, they were up over 2% last week, discretionary names were up roughly half as much. This is a chart that looks as though it can move up higher, but I suspect that if this market goes in 2023, when I say goes, it has that black swan event or resumes the bear market downtrend, that discretionary names are going to take it on the chin, probably the hardest. So I've spent a lot of time over the past several days strategizing about how I want my portfolio hedged in 2023. And what I've concluded is that we're going to dollar cost average into a very, very long-term options trade using the GLD. And I'm talking about purchasing call options expiring in 2025. That's how long out, because I don't want the time decay. And we're confident in the gold trade because gold is really beginning to perform well, dollar weaker, and the Federal Reserve is in all probability going to have to pause at some point in time in 2023. And when they do, you're going to see gold, silver, anything you could drop on your foot and it hurts, rally. Also, the reason why I bring up the short head strategy going into 2023 is that I plan on shorting the consumer discretionary names because the consumer is dead. Now, would I do it right now? No, I wouldn't do it right now. Unless, of course, next week we broke down to new lower lows. That's just pure relative weakness versus the rest of the market. But right now I could see here a W formation forming. You have the S&P 500 in blue overlaid, showing that the XLY is underperforming dramatically. Will it play catch up? The setup's here. Fundamentally, should they rally? Probably not. People are broke, but that doesn't mean you're not going to get a short squeeze, sending these names up higher. But I'll tell you right now, if they rally them up to 165, 170, I got to be looking to put on a very aggressive short position on the discretionary names if I see these events that are out there that are a threat to the overall market not go away. Case in point, the Ukraine. If that war continues or worsens, okay, well, that's a problem because energy prices stay high, food prices stay high, and the markets have to worry about an artillery shell hitting a nuclear reactor, resulting in a dirty bomb. That's just one of many examples. So weekly chart XLY looks as though it may want to rally with the rest of the market. Daily view. Daily chart looks good. RSI above 50. Stokes are rising, looking good. They were up on Friday when the overall market was down. And one other thing I want to point out before we leave consumer discretionaries, because they are a focal point, a focal sector for us going into 2023, is that the discretionary names were, as far as I know, and if somebody is aware of another sector that broke down below not just the October lows, but the June lows as well, please point it out to me. Leave a comment below. Now, emerging markets, this is the EDC. This is a leveraged ETF. It's 10% China, so we don't own it. We do not plan on owning it. Maybe we'll trade it from time to time, but otherwise we own another ETF ex-China. Members will talk about that in a moment because it's certainly outperforming the EEM, which is the unleveraged emerging market play. So as the US dollar continues to weaken up into 2023, and I think that it will, as long as you hear more and more chatter about programmable money, programmable US dollars being issued, and a cashless society getting rolled out, I don't know why you want to own dollars. I simply have no idea why. I think that they're going to try to overstep from day one. It'll result in court actions. It'll take years to resolve. And you got to hope it gets resolved in the consumer's favor. So we've seen a strong rally. Why did we get this rally? It's because the US dollar is weak. I think that longer term, though, as we go into 2023, we must be aggressive buyers of emerging markets ex-China. And that wouldn't be a short-term swing trade, folks. That's more of an investment thesis. Energy. I think energy's come a long way. And the chart from last week looks pretty bullish. But if the global economy continues to weaken up here, I really am concerned about the ability of energy to continue up higher. Daily view. A lot of topping action here. I think that this gets resolved. And I could be wrong. We do have one energy position on, actually two, if you count in natural gas. This probably gets resolved to the downside, and that's a complete contrarian play. I'm aware of that. But I do not think that energy is going to be the leader as it was in 2022, in 2023. Why? Oil prices. Energy prices are tightly correlated, or I should say, the energy stock price, the XLE, is tightly correlated with the US dollar. While the XLE has yet to break down, oil has broken down. Oil peaked out back here in March and it is now broken down to new lower lows. So we have a double top. We broke down to new lower lows in August, and now the bear market, and we are now, at least technically, percentage-wise, are we 20% off the highs? Yeah, we're in a bear market on oil, if you could believe that. Doesn't feel like it at the pump. Could it be because the president dumped the strategic petroleum reserve onto the markets? That's over, and it's still falling. Daily view. Bearish reversal bar on Friday. So what you're seeing here is every rally is noted by these topping tails, wicks, shadows, call them whatever you want. They're being sold into. Stokes are very weak. And this is a monthly chart. I thought this was a daily chart, so actually a monthly chart. But this is powerful. Really powerful. So I suspect that we're going to get lower lows on oil now for the daily view. Yeah. Horrible price action. At some point in time, energy is going to break and follow suit. So we'll be looking to short the XLE, whether it be with the short of the outright common shares or we put on a bear put spread using options. Gasoline prices breaking down. Folks, this could be one of the catalysts that causes the markets to move up higher. Declining oil prices, declining gasoline prices. Sounds like a pretty goddamn good catalyst for me. If the Federal Reserve is able to say, listen, energy prices are coming in. They're impacting core CPI. We're feeling pretty good here. We're going to still raise rates, but perhaps not be as aggressive. We're going to adopt a wait-and-see approach. You're going to see the market rip. Now, when the Federal Reserve does, at some point in time, let's just say pause, you're going to see gold rip up higher. I have been of the opinion that they're going to raise their target rate from 2% to 3 or 4%. That will give them the air cover to not be as aggressive in 2023. And while that may send up stock prices dramatically, I think that is going to do even more for gold. So while gold closed down on the week last week, it's still holding support levels. The chart is improving. Our gold mining stock trades, the gold mining stocks are outperforming gold by a wide margin. And at some point in time, gold and silver are going to play catch up. And it's at this point we're going to talk about positions. So members, let's segue on over and into our positions, and let's talk about GDXJ, outside reversal bar on the week, volume very light, RSI rising, Stokes rising, looking good here.